Welcome to Pagoda Podcast, where we explore ideas, strategies, and insights to help businesses grow and scale.
It's great to be here.
We're doing something a little different today. Usually we take a pretty wide lens, but today we're really zooming in. We're doing a deep dive into a stack of research, market analysis, and some pretty dense M&A reports. And we're doing it to answer one very specific question. It's the one that seems to be on everyone's mind lately. In boardrooms, on the golf course, you name it. Should you sell your business during a recession?
It really is the million-dollar question, or for some people listening, maybe a $10 or $20 million question.
Right. And the gut reaction, let's be honest, is usually fear. There's this idea that as soon as the economy dips, everything just freezes.
Your doors lock.
Exactly. The assumption is you'd have to be, desperate to even think about an exit when the market's down.
Yeah.
But looking at the research we have here, that feels like a massive oversimplification.
It is. And frankly, it's a dangerous one. If you operate just on that fear, you could miss a huge opportunity.
But the flip side is true too, right?
Absolutely. If you ignore the reality of the market, if you pretend it's not raining, you could walk right into a disaster.
Okay, so let's just cut through the noise. We're not here to give financial advice, obviously, but looking at the data, when someone asks, should I sell right now? What's the real answer?
The real answer is that it's rarely a simple yes or no. It's never black and white. It really all depends on three things, three pillars: preparedness, your market position, and your strategy.
So no blanket statements.
No, not. But if you dig into that nuance, the right path usually becomes pretty clear.
All right, let's unpack that. We've got a roadmap for this deep dive. We'll look at why deals still happen when things are shaky. Who actually wins in this environment? Because they're winners.
Oh, for sure.
And then we'll get into the specifics of what we're calling the 2026 lens on buyer psychology, because this year is not 5 years ago.
Not all. The rule book's been rewritten.
So let's start with that big myth. Do deals actually freeze? The common wisdom is M&A just hits a brick wall.
Yeah, that's the perception, that the phones stop ringing.
But it's fundamentally untrue.
It is. Deals do not stop. The economy might slow down, sure, but capital markets don't just close up shop. Historically, some of the best deals have happened during downturns.
But why? I mean, if everyone's worried if interest rates are up, why is anyone spending millions to buy a company?
You have to look at who's buying. It's not just your competitor down the street. It's strategic buyers and, more importantly, private equity firms. And PE is sitting on huge amounts of capital.
The dry powder.
Exactly, the dry powder. And here's the key thing people forget. They have a legal mandate to deploy it. They raise a fund, a clock starts ticking, and they have to invest that money or return it.
And returning it is a failure for them.
It is. They don't get their fees. So even if the sky looks gray, they need to be buying.
So the pressure is on them to find deals.
Precisely. But, and this is the big but, the nature of the buying changes. In a boom market, buyers might get a little sloppy. They'll overlook flaws because growth covers everything.
Right. The accounting is messy. We'll fix it.
Exactly. In a recession, the buying doesn't stop, but the buyers become so much more selective.
So the door isn't locked, but the security check is a lot tougher.
That's a perfect way to put it. The bar is raised. They're still looking, but they're only looking for the right deals. They're not buying growth anymore. They're buying certainty.
That's a perfect transition to our next point, the green light profiles. If buyers are so selective, who actually makes the cut? It feels counterintuitive that anyone would really benefit from selling now.
It does, but there's a surprising upside. It's what economists call a flight to quality. When everything feels chaotic, investors and buyers crave safety. They want stability. So if your business is a safe haven, you don't just get attention, you can command a premium.
Hold on. You're saying you could actually get a better valuation in a recession?
In terms of relative interest? Absolutely. Think about it. Supply and demand. In a downturn, the supply of high-quality, low-risk companies is really scarce. If everyone else is struggling and you're standing tall, you become the best house on the block.
And all those PE guys with their dry powder.
They're all looking at you.
Okay, so let's define standing tall. What does that look like to a buyer in 2026? What are the specific criteria?
It really boils down to three things: predictable cash flow, low debt, and independent systems.
Predictable cash flow.
So
more than just we make money.
Right. We're talking contractually obligated revenue, or at least very, very sticky recurring revenue. A buyer wants to see that your income isn't based on impulse buys. They want to know that money will still come in next year, even if things get worse.
So a subscription business versus a project-based business.
Exactly. That peace of mind is worth a lot of money when the market is volatile. A buyer will overpay for peace of mind.
Okay. Number 2 was low debt.
Critical right now. When interest rates are high, servicing debt is expensive. If a company is drowning in loans, a buyer sees that as a huge liability. It just eats cash flow.
And if they buy the company, they have to take on that debt.
Correct. So if you're debt-free, you're agile, you control your destiny, that cash flow goes to the bottom line, not the bank.
And the third one, independent systems. The boring stuff.
It's the boring stuff that makes you rich. It means the business runs like a machine, not a magic show starring the founder. There are processes, manuals, software. The engine keeps running without you there.
So if you've got those 3 things, the recession logic flips. Buyers run toward you.
In a chaotic market, safety is the most valuable asset. If you're a bond in a world of risky stocks, you win.
Okay, but we have to look at the other side. Let's talk about the red light profiles. Who needs to just hit the brakes right now?
These are the vulnerable businesses, and if you try to sell a vulnerable business in this market, you're going to get punished on the valuation.
What are those specific red flags that get you punished?
Number one, without a doubt, is messy financials. In a boom market, a buyer might say, we'll sort it out. In a recession, they walk immediately.
Because it just screams risk.
It's the opposite of certainty. If I can't trust your P&L, I can't trust your business. The second red flag is high owner dependence. The classic helicopter founder.
The I'm the only one who knows how this works person.
Exactly. Only I can close the big deals. If the business stops the second you take a vacation, you don't have a business to sell. You have a high-paying job, and you can't sell a job.
That's a tough one for a lot of founders. They think they are the value.
They're valuable to themselves. It's a liability to a buyer. Because if you leave, the value leaves with you.
And the third red light.
Declining margins. If your profitability is shrinking, it shows you have no pricing power or your costs are out of control. It's like trying to catch a falling knife.
No one wants to do that.
No one knows where the bottom is.
So if I'm that owner and I panic and try to sell anyway, what happens?
You get what's called distressed asset pricing. You get lowball offers. You lose all your leverage because the buyer knows you're scared. The advice from all the data is clear. Do not sell now. Preparation first.
Fix the house before you put the sign up.
Exactly. Don't sell while the roof is leaking. You fix the leak, you paint the walls, then you sell.
Let's pivot to this specific moment in time. The 2026 buyer psychology. What makes this year different?
The central theme for 2026 is risk mitigation. A few years ago, it was all growth at all costs, FOMO, fear of missing out.
Right.
Now it's FOGI, fear of getting in. Buyers are looking at every deal and asking, what could go wrong here?
It's a huge shift from the blitzscaling era.
The hangover from that era has set in. Buyers got burned by companies that grew fast but broke easily. Now they want businesses that can take a punch.
So what are the new valuation drivers, if not just pure growth?
We're seeing a huge focus on 3 things: automation, transparency, and resilience.
Automation. Is that just about having cool tech?
No, it's about cost control and predictability. Labor is a huge variable. People quit, they get sick. A robot or a piece of software is predictable. A buyer will literally pay a higher multiple for a dollar of profit from automation than from manual labor.
That's fascinating. A robot is worth more than a rockstar employee to a buyer.
In terms of transferable value, yes. The robot comes with the sale, the code stays.
That makes a cold kind of sense. And transparency.
This goes back to clean data. Buyers want dashboards. They want to know that you know your numbers. If you're opaque, they assume you're hiding something. Data maturity is a proxy for management maturity now.
If you can't show me the map, I assume you're lost.
Exactly. And the last one is resilience.
Right, resilience. How do you show that?
It's your ability to withstand shocks. Supply chain shocks, for example. If one supplier goes under, does your whole business grind to a halt? If not, you have resilience. Buyers in 2026 are paying for redundancy. For Plan B, they want bulletproof.
So the flashy growth story, we doubled revenue, isn't enough if the foundation is cracked.
The flashy story gets you the meeting. The bulletproof foundation gets you the check.
This leads us to a really interesting middle ground. We've talked about selling and waiting, but the research points to a third option, a strategic reset.
Yes. This is moving beyond that binary choice. It's about using the recession. A recession can actually be a gift.
A gift. That's a bold word for an economic downturn.
Think of it as a quiet period. When things slow down, the noise drops. You have less firefighting to do. It's the perfect time to look inward and restructure. to optimize.
So instead of panicking, you go into the garage and tune up the engine.
Precisely. All those problems we mentioned, owner dependence, messy operations, now is the time to fix them. You finally implement that ERP system you've been putting off, you document your processes, you train your managers.
You're using the downtime to actively increase the future value of the business.
That's the third option. You're not just holding on for dear life. You're building value so that when the market turns, and it always does, you launch from a much higher platform. You use the recession to get into fighting shape.
This sounds exactly like what Black Pagoda helps with. How do you advise clients who are stuck in that limbo?
The main thing is to take the emotion out of the decision. An owner in a recession feels fear, uncertainty. It's personal. Our role is to bring in the cold, hard data.
From I feel like I should sell to the numbers say.
Exactly. It's about clarity. It's about auditing the business against those 2026 buyer criteria. If the data says you're a green light, we explore a sale from a position of strength. If it says you're a red light, we build that optimization plan together. The goal is always maximizing long-term value, not just reacting to fear.
Having a navigator so you don't drive off a cliff.
Or pull over when you could have kept going. Sometimes the scariest roads are the fastest, if you've got the right map.
Right. Okay, we've covered a ton of ground. We busted the myth, identified the winners and losers, looked at the new rules. If someone listening walks away with just 3 things, what should they be?
First, recessions don't kill deals, they just change the market. The money is still there, that dry powder, but the bar is higher. Don't assume the door is locked.
Okay, number 1, don't believe the freeze myth.
Number 2, preparation determines your outcome. The difference between a great exit and a failed one is almost always the internal state of your business. Strong systems beat market timing every time.
And the 3rd,
Strategy matters more than timing. Don't let emotion drive. Don't sell out of fear, and don't hold on out of stubbornness. Let the data and a clear strategy dictate the move.
I love that. Strategy beats emotion. So simple, but so hard to remember in the moment.
It's the hardest thing, which is why it's the most valuable.
And that brings me to a final thought. We think of a recession as something that happens to us, like bad weather. But what we've learned today is you can't control the weather, but you can control the integrity of your house. So focus on what you can control.
Couldn't have said it better myself.
If you're listening and wondering which profile am I, green light, red light, then you need to get clarity. You need to look at your planning, your valuation, your exit readiness with a sober eye.
Knowledge really is the antidote to fear.
Absolutely. So I'd encourage you to go deeper. Check out www.blackpagoda.com. Think of it as an educational resource. They have tools there to help you understand where you stand, so you're not just guessing. It's not about a sales pitch. It's about getting clarity to make the right move.
Definitely worth taking a look.
Thank you for walking us through this. It's a complex landscape, but I feel like we have a much clearer map now.
My pleasure. It's always good to zoom out and see the whole board.
And thank you to everyone listening. We hope this deep dive helps you navigate whatever comes next. Keep building, keep scaling, and we'll catch you on the next one.